Tax season is when we find people often scramble around to try to find deductions, but smart tax planning really takes place all year round. The goal isn't to avoid taxes, it's to not pay more than you need to. So, would you rather pay more money than needed to the CRA or keep more of that money in your pocket? If you prefer the second option, then stick around. Today I'm going to share with you 7 tax saving strategies, some of which you might already know and some that might surprise you. While these strategies are going to apply to Canadians of all different income levels, they're going to be most relevant for business owners and working professionals. So let's get started. Income splitting is the way of legally shifting income from a higher income earning individual within a household to a lower income earning individual. One way that this can be done as well is through the use of a TFSA. So for example, if I'm at a certain income level within my household, I may choose to gift money to my spouse who's in a lower income earning level. They can then take that money and put it into a tax-free savings account provided that they have room. When the money is in the tax-free savings account, they can invest it, and there'll be no tax implications for doing this. One of the key benefits for this as well is that there's no attribution rules. In other words, once the money's in the tax-free savings account of the lower income spouse or even of an adult child in the household, it's going to continue to grow tax-free for life. Just a few things to keep in mind with this strategy. If you are gifting money to another family member, be sure that they have enough money to put into their TFSA if that's the route you choose to go. And of course, you need to be at least 18 years of age to open up a tax-free savings account. A spousal RSP allows the higher income earning spouse to contribute to an RSP on behalf of the lower income earning spouse. Under this strategy, the spouse that made the contribution receives the full tax deduction. So if they're in a higher income bracket, of course, this would be beneficial because the family may receive a larger refund or reduction of taxes owing. The lower income earning spouse can then withdraw the money from that RSP account in their retirement, and it'll be taxed again at the income rate of the lower income earning spouse. Even if the spouse that's contributing to the spousal RSP, so the higher income earning spouse, reaches the age of 71, which is normally the year you have to stop contributing to your own RSP, you can still continue to contribute to the spousal RSP if your spouse is younger than you. A couple things to keep in mind is that if you contribute to a spousal RSP, that will impact your own RSP room, not your spouse's. However, this does remain a really effective income splitting strategy in retirement, as it allows you to split your RSP income from your own RSP, and your spouse can take money out of their spousal RSP and be taxed at their marginal tax rate. So you probably know that a registered education savings plan, or RESP, is a great way to save for a child's education. But did you know that when you go to take money out of the RESP, a portion of it is taxable? So the money that you originally put in as your contribution can come out tax-free. However, any of the grant money that was received from the government or any of the growth that occurred in the account, well, that portion is going to be taxable. When the taxable portion of the RESP comes out, it's taxed in the hands of the beneficiary, aka the child that's attending post-secondary education, not the contributor's tax bracket. So how can we make RESP withdrawals more tax efficient? Well, if we know that our child is going to be working a summer job and have a substantial income in any given year, it might make sense to draw more of the original contributions out of the account because those will not be taxable. However, if the child is not working or working a part-time job and has a very low income, at that point I would be more inclined to pull more of the contribution and the growth money out of the account. If you're in a household and find that one spouse is earning significantly more than the other spouse, one strategy you can employ is elect to have the higher income earning spouse pay all of the household bills. This means that the lower income earning spouse has more money in their pocket left over at the end of the day for investment. Once registered accounts have been maximized, the lower income earning spouse can then invest in a non-registered account. Now, this type of account is generally exposed to taxes if your account pays out things like interest, dividends, or capital gains. However, the big difference is that any of that is going to be taxed at the lower income earning spouse's marginal tax rate. So for example, if you have investment gains of 5% a year, instead of that being taxed at potentially 53%, it could be taxed at a much lower rate, such as 20 or 30% if you implement this strategy. If you own a vacation or a rental property, you will likely owe capital gains tax when you go to sell that property if it's gone up in value since the time you purchased it. However, certain improvements such as building a new roof, adding a boathouse, redoing the kitchen, these upgrades will increase the cost base of your original investment in the property. In other words, it could reduce your capital gains when you go to sell the property in the future. Therefore, for any improvement you do on the property, be sure to keep your receipts and detailed records, because every dollar counts when it comes to calculating your capital gains tax. Splitting pension income can greatly reduce overall household taxes. Things like CPP and even your RRSP withdrawals after the age of 65 are eligible for pension income splitting. So when you're filing your tax return, especially over the age of 65, you're going to want to make sure that you file with your partner in order to take advantage of this pension income splitting. If you have money left over in your registered retirement income fund, or RIF, at the time of your death and do not have a surviving spouse, then all of the money in your RIF will be taxed, and it will be taxed as income, which potentially could be up to 53% going to CRA. For those that have a charity near and dear to their heart, they may look at donating a portion or all of their RIF to this charity. When they do that, they will create a large donation tax credit that can be used to offset the taxes owing on this RIF. In doing this, they're going to reduce the amount of taxes that their estate owes to CRA and also leave behind a legacy to their favorite charity. The end result is that more of your money goes to a cause you care about versus the CRA. The 7 strategies that we laid out in this video can save you thousands of dollars over time if planned out strategically. Is there one favorite tax saving tip that you have? If so, drop a comment below. If you found this video useful, be sure to like and subscribe. And if you want to explore more about how these strategies may fit in with your own personal situation, be sure to check out the link in the description box below, and let's schedule a quick consult. Thank you for watching.